This is the Value Investor Podcast with Tracey Ryniec. All things value, all the time.
Welcome back, value investors. So while the market has been doing its volatility here in 2025, I feel like maybe we should be taking a look at somewhere where we're getting paid for our patience. So I decided to take a look at the dividend paying stocks today. And these may or may not be cheap, but because the screen I used didn't actually necessarily include a cheapness factor, but when you start to get dividend yields over a certain level, you're kind of guaranteeing that there's going to be some kind of value there. So the screen I used was one of the predefined screens on Zacks screening tools, and it is the one that's under the income, not the value section that's on there. If you're a premium member, you know that it gives you a bunch of different screens in the predefined by the way you invest. So value, momentum, income, and then it has some fun screens that we've talked about in the past that are under just kind of the other category, which could be, small caps. So it could be a market cap type thing, and just various other more niche type of screens go into that other category. So take a look at everything. Don't just look at the value screens when you're in there under the premium thing. But I know many of you are not in the premium, so that's why I go in there and look at some of these screens for us. This screen was called Top Zacks Rank Dividend Pairs. So it's pretty straightforward. And the rank is number one's the strong buys, but also number two's the buys. So that's considered the top ranks. And then dividend payers, this one was pretty generous and it looked for 5% or more. So that's why I feel if you are searching for yields above 5%, which is pretty high for this market as the S&P 500 is, below 2%, then you are getting stocks that are probably on the cheaper side, not necessarily, but likely to be with a yield at that level. You're also going to get MLPs. So those are master limited partnerships at 5% and higher. And you're going to get REITs, the real estate investment trusts. And remember, for both of those, you're owning the pipeline and you're getting the rental income on that pipeline. And for the REITs, you're getting the rental income from the real estate. And so those tend to pay out higher. And for the REITs, they have to, under the law, pay out 80% of their income out back to the shareholders. So that's why you get these big yields going on. So I ran this screen and it gave us 34 stocks. That's a pretty good number with these higher yields. And just scrolling down, I chose three ones that maybe we've talked about in the past or that many of you know when you're looking for income. And let's dive into what those are, what you're getting here during this volatile market if you actually are trying to get yield and get paid to just kind of sit around for your patience, right? And if you can get some of these with the big dividend, it kind of pays for itself in some respects. Now, some of these do not see big gains in the stock, because that's what you're getting with the dividend yield. So you're not expected to double your money or anything in the actual underlying stock. But a lot of times they also give you some protection on big sell-offs, not complete as we're about to find out, but some protection in cases of volatile markets. But they are cheaper now than they were and the start of April before Liberation Day. And so let's dive in to see what is going on with these stocks with the high rank. And the high dividend yield. Maybe some of these could be a good addition to your portfolio here in 2025. Okay, we're going to start off with one of the MLPs, with one of those pipelines, because I know you all love them. Enterprise Products, ticker E as in Edward, P as in Paul, D as in David, EPD. It is a fan favorite. It's yielding right now about 7%. It's at 697 on Zacks. So just about at 7% right now. That's pretty juicy. The actual amount is $2.14. Stock is right now trading at $30.57 when I'm recording this on April 23rd. And what has it done year to date? So year to date, it is down a little bit, 3.7% year to date. So it is off of those recent highs. But over the last month, it's actually down 9.8. It is up off the lows of the reciprocal tariff day. April 9th is when we had reciprocal tariffs. It did crash down into that day, but then we got the pause on all the reciprocal tariffs, and then the stock has recovered a bit, but still down 9.8% in the last month. So it is a lot cheaper over the last month than what we've seen. Forward PE is at 10.5. It has a PEG of 1.3. What is going on with the detailed estimates? Because it is a Zacks number 2 buy, but it is about to report earnings on April 29th. So we haven't had those earnings come in yet, but these earnings on the pipeline are pretty consistent because it's not going off of the price of crude or natural gas, whatever, or liquefied natural gas, whatever's running through that pipeline. It's going off of the people paying to run their stuff through the pipeline. So this year, 2025, earnings expected to be up 8.1%. That's pretty nice for this type of company because you don't normally see a lot of earnings growth for it. 2026, another 5%. Estimates are higher for 2025 in the last 30 days. 2 are higher, but 1 has been cut. And the same is true for 2026. But the higher is obviously taking some precedence there. It did beat last quarter by 5 cents. It missed the prior 2 quarters, but only by a penny. So that's kind of how this company rolls too. It is so consistent that you don't get a lot of big beats. You don't get a lot of big misses because there's not a lot of surprises there. But pretty consistent, and nobody's really concerned if it misses by a penny or 2 pennies for that particular quarter. So this is an interesting one with that high yield, and it has pulled back. So Enterprise Products Partners might be a place to hide out here. EPD is the ticker. Okay, let's switch over to a stock I know we've talked about. It's been kind of a value trap for many years now. Pfizer, ticker PFE. It's one of the few of the big drug stocks that has not really gone come back. It has stayed depressed for over 20 years now, I want to say. And I'm just going to take a look and see what the 5-year, 5-year chart now for Pfizer, it's actually down 36.9%. So this is one I've talked about in the past to be cautious on, even though it has a big dividend. So its dividend right now is yielding 7.6%. So even bigger than the pipeline. And when you start to get a big dividend like that, when it's not a REIT and not a pipeline or some other master limited partnerships, but they do tend to be pipelines, then you start to get a little nervous. Like, why is the street rejecting this company that has these kind of cash flows so dramatically? It has a PE of 7.5 right now. That's why it always shows up in the screens with a PEG ratio of 0.55. So the PEG is also intriguing because we could have a PE that's that low, but we've got to have something going on with the earnings to get a PEG also that's attractive. But no, not really. 2025 earnings decline of 3.9%. $2.99 they're supposed to make. They made $3.11 last year. And then next year, just $3.02. So they don't really have any drugs or anything going on in the pipeline that's going to be a catalyst, even going forward, but still paying that dividend here. But why do we have the high rank? It is a number 2 buy. So one estimate has been revised higher in the last week, and then 3 in the last 30 days. And the same, that's for 2025, same for 2026. So something is going on that they're feeling a little more bullish here. It's not a big correction higher though. So I said they're looking for $2.99. It was at $2.97 just 30 days ago. So that's, only 2 cents higher, but it is still a revision higher, which does give the signal for the Zacks algorithm that, hey, some analysts are starting to get a little more bullish here. It is also reporting on April 29th. So these 2 big dividend payers reporting on the same day. And so we'll find out then what it's looking like. But I would be a little more cautious on this one. I know some of you are saying like, how low can it go? It has to, rebound at some point. Year to date, it's still down 15.9%. And then over the last month, because the president has threatened to put tariffs onto the drug makers if they don't bring their drug manufacturing back to the U.S., it has seen a hit in the last month as well, down 14.5% in that time period. But it is off the lows that were also on not Liberation Day, but on the reciprocal tariff day, the start of them, but they were paused, and that was on April 9th. So we're off a little bit off of that day. Last 5 days, it's down, but only 1%. Enterprise is down 2.5 in the last 5 days. So this is one maybe to keep on the radar. But many people asking, how low can it go? How cheap can it get? But we've seen with some other companies like Walgreens Boots Alliance that it can go a lot lower when there's other stresses and strains going on the company. So keep that in mind with Pfizer, ticker P as in Paul, F as in Frank, E, PFE. Okay, then I want to wrap it up with a REIT this time, Vichy Properties. I know we've talked about it in the past, but I think it's been a while. V as in Victor, I, C as in Charles, I, VICI. They are in experiential assets. They have 54 gaming properties. So gaming, hospitality, wellness. Some of these brands like Canyon Ranch. Those are the great hotels, wellness resorts you can go to kick back and try to decompress. Highly recommend Canyon Ranches. There's a couple of them around the United States. The famous one down in Arizona, but there's a couple. There's one in Miami. I think there's one in New York State, up in like the Poconos or somewhere out there. Just very nice, relaxing places. They also have Lucky Strike, the entertainment venue. They have Kalahari for those of you in the Midwest who've gone to the Wisconsin Dells. We know about the Kalaharis and the Great Wolves also in the Wisconsin Dells, but also other locations. These are kind of great family resorts, water parks, and hotels. So that's kind of what you're getting with experiential assets. So I do like this area of real estate. It's a growing industry. You'd think it might be recession proof, but we do know from 2008, 2009 that on the gaming side, at least, consumers still do pull back, even though it does have a kind of a component of recession proofing and the gaming. Like you're still going to go to Las Vegas, but they didn't in that severe recession. They did pull back on even trips to Las Vegas and Reno and the like during that recession. So it's not completely recession proof, but I still do like this area as not getting hit quite as hard as some of the other hospitality areas. And wellness, we don't know, but seeing as it's good for, decompressing and stress relief and things, maybe it might do well in a recession as well, but I would expect some pullback in a recession on these. But we don't have to deal with the tariff issue quite as much on VC, but the recession side of it, we might. So it's a number 2 as well, a buy stock, and it is yielding 5.25% right here. So obviously we screened for over 5. So all of these 34 stocks are over 5. But I'm liking anything at 5. You definitely notice when it comes into your account at 5.25%. And that is $1.73 for Vichy. It is trading at $32.45 right now. And what has it been doing? So year to date, Vichy is actually up 12% here year to date. Maybe because it's not a tariff play, so nobody's all nervous about it being in the tariff area. So that's pretty nice. And then over the last month, when these tariffs really hit, it did pull down after Liberation Day, during that sell-off. So it did see some of a sell-off, almost 10% actually, by April 9th. And then we got the pause and everything did rally. We had a 90% update on April 9th. And then it has rebounded pretty dramatically. And now over the last month is up 2% in there. But still pretty cheap. Let's take a look. Forward PE of 14. It does have a higher PEG ratio though of 4.2. So, let's see what is happening. Why does it have a number 2? They haven't reported yet either. They're reporting on April 30th. So the day after the other 2, we will hear from Vichy. So next week is big for these dividend payers. Earnings pretty consistent on this type of company, expected to be up 3.1% this year and 2.9% next year. These are the types of companies that did get hammered in the pandemic and, maybe cut dividends and all of that. But we don't know for sure what will happen in a regular recession, not an entire economic shutdown recession. But revenue expected to be up 3.6% this year and 2.6% next year. So again, you don't get crazy growth. That's why you don't want to overpay for these companies on a PE basis. But I don't think you really are here at 14 times. That's pretty standard. It's not dirt cheap, but we are getting the 5.25% yield to hang out here and see what happens with the rest of the market. So that's Vichy Properties, ticker VICI. So you can see it's an interesting collection of just these 3 stocks that was in the 34 stocks. A lot will happen with the Zacks rank as this earnings season goes on. And it will change daily. Be sure to check back in after these companies report earnings again on April 29th and April 30th, because there are going to be updates to these estimates. And hopefully they're going in the right way. And we get some more analysts even raising further in the next week after these earnings reports come in. So let me recap the stocks again. So we had Enterprise Products. EPD is that ticker, almost 7% yield. It is a master limited partnership. And one other mention for the MLPs and the REITs, you should talk with a tax advisor about the tax implications of those, because they don't pay out the cash the normal way that you get just with a normal capital gain dividend with the other stocks. It is taxed at a different way. So be sure to consult with that so that there's no surprises during tax season, because that's the last thing you want. But Enterprise yielding just about 7%. So that's juicy. Then we had Pfizer. Not sure if this is signaling the 7.6% dividend yield, good or bad, but it is off the lows here and it's cheap at 7.5. Ticker PFE. Then we had VC Properties, VICI, the REIT at yielding 5.25%. I always like to live vicariously through these REITs. And if I can't go out and buy the buildings myself, I do like to own some REITs to be a landlord. And then I don't get the calls late at night when something's going wrong with that hotel or, maybe actually one of the things that could happen with some of their brands at VCs are maybe foreign tourists aren't coming as often to, say, like a Canyon Ranch. And that could be an impact there. But we'll see. We'll see on this next earnings report what they're seeing there. But I like just owning the real estate and reaping the benefits, because nothing wrong with 5% or higher here on the yields. It's pretty good to be there for being patient during this market volatility. So be sure to keep doing your screens throughout this earnings season. You can get the Zacks Stock Screener for free on Zacks.com. There's a screening little tab up at the top. You won't get the premium screens, obviously, for free, but we do have a basic screening tool in there that you can click on. When you click on the predefined, it says basic, then it says premium, and it has our little logo next to the premium. So that's always a giveaway that you have to pay to get that one. But just clicking on it right now, we do have a classic value with growth screen on the basic screens. There's a bunch of growth screens. Then it lists bonus screens. So these are always kind of the intriguing ones, like low prices with positive broker rating is one of the screens. Low beta value. That could be interesting. Maybe I'll have to run these screens for next week, because there are some of these great, basic free screens that we can run. It does have the high beta stock screen on here too, which are also interesting. And one that we won't care about, high PE stocks. Why would we want that? No. High PEG ratios. No. These are all bad for us, but still intriguing and fun to run those with the highs. But it does also include the low PE stocks, low beta, low PEG ratio, low price to cash flow, low price to sales, on here as well, and one that's at 52-week highs, which I do like to look at as well. So go check out our free screens. They're free. Why not? And you can get a nice little list of stocks going that don't include the Zacks rank. And then listen in on the podcast every week. I'll be bringing you some premium screens, as I always do, with both the rank and other juicy tidbits that are in there on those premium screens. So be sure to get us on Apple. We're on Spotify. We're on Amazon Music. Anywhere you can get the podcasts, including YouTube. We have a whole podcast page. Subscribe over on Zacks Podcasts to get our YouTube channel. But be sure to get us somewhere, and I'll see you again next week with some more screens and stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.